Hi, Joe Lopresti here with the Arlington Wealth Management Proactive Strategy Update for Friday, December 2nd. Well, this week our market model managed to move back to a global buy signal. 2022 continues to be a very choppy year and volatile trading in both the stock and bond markets. We haven't set a flash alert out yet, as we will probably over the weekend or maybe early next week, because we sense there isn't a rush to move back into the market with this buy signal in short order. So this is the second time the model reversed course since the first sell signal back in April this year. And with the change in the model status, we move off of maximum defense and begin to move the strategy towards offense. But we'll do so cautiously for the reasons that we'll explain in this video, as well as further detail in the flash alert that will come out. So looking back now, the equity markets peaked either late last year or early this year, the global markets last year, the US market this year. Going further back in 2021, past triggered tactical sell signals indicating the surge off of the COVID low was unsustainable and there was likely to be a give back of some of that gain. As we moved into this year in January, there was a warning from our 210-day indicator telling us that the correction that was developing at the time was likely to be something more than just a random short correction. Then the global sell signal occurred on April 22nd, indicating the cycle was potentially changing from a bullish to a bearish cycle. These signals from our model helped us move to a defensive position. We believe the model did an admirable job in helping us preserve wealth in what has really turned out to be a difficult market for many investors this year. With the PAS market model now improving to a global buy signal, it increases the probability that the storm has passed. Right? The global sell signal is our tornado warning. The global buy signal is our all's clear. And potentially a new bull market is beginning. If the bear market concluded, it lasted about 10 months, and the MSCI All Country World Index dropped about 26% to its low on October 12th, as you could see here on the screen. So the severity and duration of the bear market was meaningful, but less than average from a historical perspective of bear markets. So moving to the sidelines, even during downturns that are less than average, provide peace of mind during a period which is uncertain for many investors, even during the shorter bear markets. And it's worth showing and mentioning that the global bond markets also experienced a huge decline this year, the worst on record by some measures. The Barclays Global Aggregate Bond Index peaked about a year before the stock market. So you could see that with the orange line on this chart. And it dropped more than 25% to the October low off of its high. So both stocks and bonds had a very difficult period, with the bond market peaking first, followed by the stock market, and both of them dropping greater than 25%. So while the market model's turning positive, we continue to get recession warnings from our economic models. They continue to point lower and toward a deteriorating economy and a probable recession most likely beginning next year. The latest economic data for October shows no improvement, as you can see here with these lines continuing to move down. In fact, the numbers are getting worse. When we look at this blue line, the very long leading index, this is as low as it's reached dating all the way back to the 1980s recessions. And the red line, the leading index, as you could see, also continues to move lower. And the weekly leading index, same story, continues to move deeper into recession territory. So the current setup in our models is really quite similar to what we saw in August, when the market model moved to a short-lived buy signal. At that time, the economic models were still not firmly calling for a recession, but were clearly moving in that direction. And as a result, we speculated that the August buy signal would likely be a false start. We sent out that flash alert to you in mid-August, and we moved cautiously during that buy signal at that time. In hindsight, that turned out to be the right approach. 2 weeks later, after the July economic data was released, the recession warning turned on, and we strengthened our conviction that the buy signal in August would fail to materialize into a sustained uptrend. We sent out another flash alert at the end of August or early September. And the market model then quickly moved back to a sell signal. And you could see the flash alert that we sent out in mid-September notifying you of all these different changes in the model. So the back and forth signals in the PAS model are unusual. However, they're not unprecedented. And we're going to look at some other times in history when we've seen similar type of action. So let's take a look at our overbought, oversold indicator, which kind of demonstrates the choppiness of trading. This is going back to the beginning of the year and the high in the market. And at that time, our model was still on a buy signal, indicating a bullish cycle. We talked about how there were tactical sell signals. There was a warning in January from our 210-day indicator. Then here in April was when the first global sell signal hit, and that's when you see the separation of the channel from the bull cycle to the bear cycle. Then here's where the first false start buy signal came in August, and that quickly faded back into a sell signal. You could see how the market moved to the lower end of the bear trend channel in both of these cases. And now it's getting a reasonably strong rally, and that's flipped the model back to a buy signal. And you can see the very start of another potential bull channel beginning. Now again, this type of back and forth action is unusual, but it's not unprecedented. Let's take a look at some other times in history when we saw similar movement to put some perspective into today's market environment. So we're going to go back in time a bit to another bear market that in many respects, in my view, resembles the current market condition. And that's starting in the year 2000. That was also a time when stock prices were very high according to our market valuation indicator and began to come off of the highs. Similar thing happened at the beginning of this year. Of course, that doesn't mean that this market cycle is going to resemble that one, but there are some similarities, I believe. And we could see at the beginning of the year, we were still in the bull cycle. We could see when the first sell signal occurred during that market cycle. And what is a bit different is it lasted for a very long time before we got the first false start buy signal. Right? So what we could see here is 1, 2, actually 3 false start buy signals occurred during that bear market. It was the fourth buy signal that really followed through and developed into a significant market opportunity. So while these things do happen, what's important to point out is that they tend to be very short-lived, usually within 1 to 3 months. The model will flip back into the sell signal if that's the direction we're going. We're going to talk in a minute about how there's certainly a possibility that we don't get a false start this time, that it does develop into a more durable market opportunity. And we'll talk about that in a minute. But just showing you how in times past there are some back and forth movement in the model. And what we want to be sure we do is don't get lulled into sleep to just assuming that when we get these buy signals that they're always going to be false starts and short-lived. We want to move in the direction of the signal because when that trend develops, you could see a really significant opportunity. And in fact, that was just the very start of it. You could go out, basically another 4 years, right? So that really kicked off about a solid 4+ year bull market, right? So these little breaks in the bear market can happen, as you could see. But it's important that we pay attention to them because we don't know which one is going to start the next bull cycle. We could use some other observations to put probabilities on whether it's likely the start of a major bull cycle or if it's likely to be a false start. but it's difficult to know with certainty. So with our PAS models giving conflicting signals, market model positive, economic model clearly pointing down and deteriorating, there's no sign that there's improvement in even that very long leading indicator, which you may have noticed on that chart turns up well before, sometimes even before the recession starts, or sometime in the middle of the recession. We're not seeing that now. So we have to prepare for various potential outcomes because we have conflicting signals with our valuable models. We believe the following scenarios are possible, all to varying degrees and really all based on the economy's path. So scenario number one, the economy somehow is able to avoid a recession. The Federal Reserve will have to be near perfect in their campaign here of hiking interest rates just enough to cap inflation, but not too much to tip the economy into recession. In my view, in order for that to happen, it's going to require the Fed to stop raising rates very soon, sooner than expected, and to pivot to cutting rates shortly thereafter. In this case, the bear market may be over. The low may be in place, and the latest buy signal could very well kick off that long uptrend like we saw occurred back in 2003. In our view, that's a low probability, but a possible outcome that we have to be prepared for. Scenario number two, recession occurs, as currently forecast by the PAS economic models, but not for many more months. The recession warning signals designed to warn in advance of a recession. There have been economic cycles where that warning came well in advance, 1 to 2 years even, before the recession started. If this scenario plays out, it could pave a runway for the market to push higher for several months before the economic downturn begins to impact stock prices. Now, we view this as probably a medium probability for this type of scenario. And we give it a higher probability than scenario one. It also lines up very nicely with the seasonality and the election cycle that we've discussed in our recent PAS updates. We're in the middle of that best 6-month period in the 4-year election cycle. The third quarter of the midterm year kicks off that strong seasonal period, and it stretches into the first quarter of next year. The S&P is up about 14% already this quarter, and that started right on October 1st. So if the recession doesn't begin, say, until late 2023 or even not until 2024, there's some time here for the market to rally before another peak is put in, and that tends to lead the recession by at least a few months. Scenario number three, a recession begins in the next few months. In this case, this market rally is likely to fail to sustain into a long-term trend, and the buy signal that just occurred will be another false signal, just like what happened in August and happened multiple times in the 2001, 2002, even into 2003 period. The recent strength in stocks is a bear market rally, not the beginning of a new bull cycle, and it fades in the next month or two before another leg down in the bear market develops. We believe this is the most likely of the three scenarios. However, the other two, if you add them together, probably have equal weighting, right? So we have to prepare for the potential of either direction, a failure of this market cycle in the near term or a potential medium or long-term advance in stock prices if scenario one or two end up playing out. There are a couple of other observations worth mentioning. With the bond market rallying over the last 2 months, market-based interest rates have been dropping. Bond prices and interest rates move inversely. Higher bond prices equal lower rates. The 10-year Treasury bond market rate has dropped from a high of 4.33% in October to 3.55% currently. That may come as a surprise because all we hear about are how interest rates are moving up. But there's a difference between the interest rates the Fed controls, the shorter term interest rates, and the interest rates that are market-based, off of supply and demand in the bond markets. Historically, the bond market does a really good job of sniffing out a recession in advance. Long-term interest rates tend to drop going into a recession. We have to be aware that while they've dropped quite a bit in just the last 2 months, they're still up meaningfully from their summer of 2021 low when these rates were just about 1%, slightly above. Now they're 3.55%. So they've come off of their high, but it could just be a short decline in a longer-term trend and not a key reversal. But this is certainly worth monitoring. Interestingly, the Fed keeps ratcheting up the short-term rates as the market-based rates are dropping. Right? So the Fed controls a few different interest rates. Probably the most widely followed is called the effective Fed funds rate. It's currently 3.83%. So market-based long-term rates are now below where the Fed's target rate is. That means the yield curve for the 10-year Treasury bond is higher than the Fed funds rate is lower. It's inverted for the first time in this rate hiking cycle. And that is best demonstrated right here on this chart. The orange line is when the Fed hikes interest rates. So you could see each interest rate hike, they influence that Fed funds rate. The latest interest rate hike coupled with the drop in the bond market interest rates. This is a day or so in arrears for some reason. Today, the bond market interest rates are 3.55%. So we have almost, say, about 1/3% inversion in the yield curve. And that is a significant change in what's happening on the interest rate front. An inverted yield curve is important because it indicates the Fed has likely hiked rates too high. The current level will eventually harm the economy, which usually translates into lower corporate earnings and eventually stock prices as well. Now, the Fed's going to meet again in about 2 weeks, and the expectations are they will raise rates another 0.5%. So we then have the orange line somewhere up here. And unless the 10-year Treasury yield is able to rise quickly, it's going to be even further inverted. We're seeing a lot of conflicting signals. You could see our market model positive, our economic model negative. However, with the global buy signal, we have to pay some credence to there's a potential that somehow the Fed's able to navigate through this and avoid a recession. If that's the case, we may be in front of a significant wealth building opportunity. We have to be prepared for that. If a recession happens, but not for a long term, this could be a liftoff to some sort of medium term type of opportunity, a cyclical opportunity to make some progress in what might be a longer overall difficult market environment for the next few years. That sort of thing could be very well supported by the positive seasonal and election cycle tendencies discussed previously. However, our concerns about the economy and the potential for recession temper our outlook here. The recession warning indicators remain poor overall, and in our view, the success of this global buy signal will very much depend on the economy's path. If we avoid the recession, or one doesn't start for a long time, the market could rally to new highs. If a recession happens in the coming months, as predicted by our recession warning models, then this could be a short-lived rally only to fade to another leg down in a longer bear market. With conflicting signals from our models, we begin to move off of the sidelines, we begin to move away from maximum defense, we begin to move away from expecting a longer-term bear market until the global sell signal comes back on, if it comes back on. We don't want to be positioned for a bear market. We want to begin to look at the potential that there's some level of wealth building opportunity that we're being presented with here. It could be seasonal, or if somehow the Fed's able to avoid a recession, it could be longer term in nature. More details will come in the flash alert that we'll be sending out shortly. That's going to wrap up this update. Thanks so much for watching. Enjoy your weekend.